Talking a bit about the world of corporate finance, but specifically aimed at small and medium-sized business owners.
It's about sustainable EBITDA. What is this business going to generate next year and the year after and the year on a sustainable basis?
As an advisor to the vendor, how would you suggest they structure that?
Firstly, I would always, when we're doing a management buyout, look for the management team to put something on the line.
Next one on the list, I think, that has this area of mystique around it that people don't want to admit but they don't know, is this exact area. How does an exit work? Morning, Oliver.
Morning, Dave.
You all right?
Yeah,
busy?
Yeah, not too bad.
I find myself busy at the moment, being bombarded by all this sport that's around. It's the real peak season for sport, isn't it?
Yeah, I think we've had quite a filled summer, haven't we? With the
spoiled, really.
Yeah, no, absolutely.
You watched much of Wimbledon when that was on?
Yeah, no, Wimbledon was good. Obviously, not too many English people lasting for that long, was it? But still,
that's part of the tradition, isn't it?
Yeah, no, absolutely. But
Tour de France.
Tour de France. I think the cricket's been phenomenal, hasn't it?
That is amazing.
Yeah, I think that's quite. And then the Test cricket probably needs it as well. Sort of that.
They were saying that match almost resurrected the concept of 5-day cricket. It go right to the wire on the 5th day.
Yeah, I suppose it's the popularity that India pulls, isn't it? Like they are such a big nation.
Gives so much energy, including Brits with Indian heritage. It really adds a bit of frisson, doesn't it, to the whole atmosphere?
Well, I suppose that they need it because they're talking about like the West Indies, for example. They don't.
Did you see that defeat they had to Australia? Was it all out for 29 or something crazy, wasn't it?
They're saying they just don't get paid enough, and they're not, so they're probably
But
playing
they were
the
such
IPL.
a force in cricket before, weren't they?
Like Courtney Ambrose,
I
Wardy Walsh.
remember that,
That was good, those days.
Who was the guy that didn't have a neck? Was he a bowler? There was some characters that came out of that team, wasn't it?
I mean, that was a serious team, wasn't it?
It was. So we've had that, we've had the cricket, we've got the women's at the moment, the European Championships. That's exciting. They're doing very well as we speak. By the time this goes out, it'll all be over. So we'll see that Tour de France.
And a bit of horse racing.
Are you into horse racing as well?
Yeah, no, very into horse racing. Yeah, so
that's a field I've not really ever been into. That's interesting. Yeah. Do you have a little flutter on it?
I have a little bit of a flutter. No, it's always good. I mean, like everyone, mainly focused around sort of like Cheltenham Festival and the Grand National and all of those sorts of things. More of a jumps racing fan, but still there's a lot of good summer racing as well.
Well, when the fun stops, stop. And on that topic, we should perhaps start a podcast.
Fantastic.
Yeah, great. Hello and welcome to another episode of the SME Growth Podcast from Wellmeadow, where every week we try and come up with something useful, interesting, or humorous sometimes for the benefit of owners and managers of small and medium-sized enterprises. And usually it's me and Rich here, passing the time of day and sharing some of our wisdom or otherwise, but this week we're lucky enough to have a guest in Oliver Wadlow.
Hi, thank you for having me.
Welcome to the show. Thanks for coming in.
Yeah, no, absolute pleasure.
Good. Now, I'm going to introduce Oliver in a minute, but you're coming in today, as people will have seen from the title on the list of podcasts they've just scrolled down to find us. We're talking a bit about the world of corporate finance, but specifically aimed at small and medium-sized business owners, maybe, and in particular, looking at the options they have for an exit.
Yeah.
So that's going to be interesting. I'll tell you why in a minute, but that has triggered a few conversations recently where I think this is very timely. So thanks for that. But in time-honoured tradition, we have a little quick run-through of our previous 3 episodes. So this is episode 132 today, which means the last 3. 131, we talked about remote working, and that was triggered by an article in the Harvard Business Review, which had come up with some new research on it. And that hasn't gone out yet at the time of recording. Obviously, you won't have been able to listen to that one. But it is fascinating because clearly remote working really divides people. It seems to be a Marmite topic. You either love it or you hate it. And the stats on people that would rather leave their job than go back to the office are horrific. So you can't really force people back in again. But the long-term effects are now starting to be researched a lot more. So that was an interesting episode. 130 before that, a bit self-serving, but we were retelling some horror stories from CRM implementations that Richard and I have been involved in, where they didn't really engage anybody that knew what they're doing. They tried to just sort of muddle through, and we had a couple of nasty little horror stories to share there, hopefully to inform others of the perils if they're going to DIY on that. And the one before that, episode 129, was on burnout of leaders in business.
Okay.
And what I particularly liked about that episode was the phrase that if the leaders are feeling a burnout, then that is the canary in the coal mine, that there's something wrong with your business model. either your org structure, your product market fit, or just how you're running the place. So it's not something you just have to persevere through and get to the other side. It's a signal. You got to listen to it and do something. Have you listened to any of our episodes recently?
I think the most recent I've listened to was actually the one with your daughter, actually, which was I think fascinating. Just different perspective, because it's something, different generation, Gen Z, as you said.
19-year-old. Yeah,
I know. I think the thing that struck me was how young she was during COVID, and suddenly that we all feel that's quite recent, but actually it's a way ago, and it's life has changed quite a lot. And
now they're starting to enter the workplace.
Yeah, absolutely. Already. So the ones who've been affected whilst at school, I think, very interesting, very interesting.
Yeah, thank you. That was episode 116. If anybody wants to go back and listen to that one. And there's another episode we've done which is close to your heart, because you're a non-exec director at a company where we interviewed the MD of.
Yeah, that was...
back in episode 46.
That was Nathan.
Nathan Blissett, that's right, on Dwello Mortgages.
Yeah.
A fascinating character. I mean, notwithstanding his background, converting from professional footballer, and we talked a bit about that as well. But he was great at really just, opening up and simplifying the mortgage market and debunking some other stuff.
And I think people really do need the help, particularly at the moment with everything that's going on in the sort of the debt world and inflation and everything like that. It's a fast-moving piece. He's
a great guy. And we met him actually at a business exhibition where he had a whole stack of donuts to give out. And not surprisingly, his stand was very popular. So if anybody's looking to do an exhibition soon, just get loads of donuts. It seems to work the trick, get people's attention.
There's a local firm that's quite good at it. So
there is. Yeah, exactly. So Oliver, tell us a bit about you then. You're obviously very integrated into corporate finance. You've come out of bigger companies. You run your own shows. So what's your own show called?
Yeah, so our business is called Alinea, and we specialise in corporate finance, which often is a term that people don't fully understand what that means, because it sounds like we're raising debt.
I think their eyes glaze over a little bit. Oh, corporate finance? What's that?
Yeah. I suppose it's it's a terminology that sometimes can be confusing, but I suppose ultimately what we're doing in corporate finance is we're advising business owners business owners on their exit options ultimately. So we're guiding them through transactions. So it's lead advisory, and that's whether it's a company sale, whether it's a management buyout, or everything in between, and also acquisitions as well.
So the reason that is particularly apposite at the moment, as I said in my intro there, is that when you work with boards, and you do this as well, you do some non-exec work like we do, and so you have that great privilege and honour of being able to go inside the boardroom of these companies and see what's going on. And a common theme that I come up with, maybe you do too, is that for the non-financial people in the room, the world of finance generally, even just financial reporting, P&L, balance sheet, cash flow stuff, is already a mystery to lots of the people in the room. And so we spend a lot of our time debunking that and helping make sure that everyone is understanding it enough that they can make a group decision on it rather than just defer to the FD. The next one on the list, I think, that has this area of mystique around it that people don't want to admit that they don't know is this exact area. How does an exit work? And for not just business owners who would love to know it but don't want to show their ignorance, but those around them that might well be part of a solution, whether that be MBO or other, we'll talk about, they also don't want to ask about it. So the idea of today really is to offer that to people. They can listen to it anonymously and become experts in half an hour.
Absolutely.
No pressure.
I think it's a very interesting topic because it's obviously a very important topic. And I also think it's a topic that people sometimes don't think about till very late in their business ownership, whether it's, you see people in their 60s and 70s. And the reality is they need to be thinking about it far sooner than that.
Yeah, it's a bit late in the day. And you described in our preamble before recording that some people only start thinking about it when they receive one of these mass emailer type promotions.
I suppose, like everyone, it's when there's something needs to be triggered to start thinking about the whole thing, and they might get a postcard or a letter from one of these main sales brokers, and they will, in that letter, they might have a picture of a beach or something like that. But the reality is, it will it will push them into explaining a company sale. They won't, in that, give much more detail. They just say company sale, and that's their first sort of. I find often it's their first journey into that process.
And you also talked about some of the toxic elements, the way they can be run, and clearly there are loads of great companies doing that as well, but there's a spectrum, and some of the biggest have got big because they've worked out a model that works. And the sandy beach on the postcard, tick, that's the first one, sell the sizzle, not the sausage, that sort of thing. But another one is expectations of value. And in early stage discussions, that really can skew the pitch quite badly.
Absolutely. So they're going into it in the wrong terminology, if that makes sense, and their understanding of what their business is valued at. And I think it's very interesting because people run these businesses for, we can get into the detail on these types of exit available, but they run these businesses for decades, and whether it's a vocation or a passion, they don't really think. They might understand obviously what the bottom line is, but they don't really think about the value they're creating. And sometimes, they're so ingrained in the process, which I think is something you'll probably come across in your profession. They haven't actually really established much value in the business because it's all in their heads. Yeah. Does that make sense? And they've got, customer concentration beyond belief. Yeah. They haven't got any contracts. It's that sort of thing. And actually, have they built much value? So although that might be generating a profit every year, actually, when you come to sell it to somebody else under a different ownership, has that got tangible value that
exactly.
You can sell?
And when we've been involved in these sorts of discussions on behalf of our clients, we go in and meet a company for the first time. They are trying to sell the pitch that they can back off pretty quickly and the rest of the company will run. So that's the first thing you have to test. And often where it falls over, it actually is still dependent very much on the current owner managers. Yeah. And whilst they've got people around them, they're not actually taking the day-to-day decisions. Yep. Then you look at the pipeline and say, well, where do you get your work from and how much have you got coming through and how much that's going to convert and how much have you been involved in converting that rather than some of these colleagues that you think are around you.
And I suppose you hear they're not, they'll say it's not reliant on them, but you'll start to hear all these conversations that they are involved.
Yeah. We have 2-week holidays and it runs perfectly well without us. Yeah, but how much is queued up for you to come back and deal with?
Yeah. I think the reality is, and we can get into it, but the buyers have become a lot more aware of this now. And actually they've understood how to work with them over that period of time post-acquisition. Yeah. So I don't think it scares them as much. But ultimately, the less it's ingrained and all sat within you, that's better because it's going to give you more value for your business.
Kind of one of the key takeaways from this, isn't it? That if the business is still being run by you, it hasn't really got a value to anybody else unless you're expecting to stay around and you're just looking to take some cash out.
Because actually, you've just got a job.
Yeah, it's just a job, yeah. Okay, so let's run straight to that point you've mentioned, the options available then. So there's a spectrum, right? Yeah. There's a lot of things you can do. So take this scenario, you've got an owner-manager, 100% shareholder maybe, or split with spouse, and they're looking to do some form of exit. And I'm not going to constrain that as to whether it's 100%, partial, or timescale. So just describe the landscape for us to how people could think about it.
Yeah, so I think, and we can go into each one a little bit more detail, but I think there's a lot of different areas. So the first thing that is available is like sort of a management buyout. Right. And that is where you've got a 100% owner, he's got a great management team, he or she are involved in the business day to day, but actually they've got this second tier of management team who are great at running this business, and actually if they remove themselves a little bit more, probably will allow them to step up because there's always that friction, isn't there? You're suppressing sometimes. So the reality is you could do a management buyout, and you a lot of people go to us and say, well, look, how are they going to afford it? Well, actually, I suppose the business can afford it. So there's different options to that. What you could do is do a management buyout where you would sell your business, but you would be the bank. So you would finance it yourselves as the business owner, and then they would pay you back over a period of time. And you may earn some interest on that money, depending on how you structure the deal. But that's a great way. That's a great way of like de-risking. You don't have to open your business up to a third party, but that's one of the areas.
And you back off pretty much when that deal's done, or
from myself? What we often find is we'll help them with the modelling. So to make sure, like the 3-year forecast, let's really work out what can this business afford in terms of deferred consideration. What's the value of the business? What works from a sort of management perspective and what's from an owner perspective. We act for the business, I would say, in the best interest of the business. We want that business to run successfully.
And is it always the case that the owner themselves, the vendor in that sense, stays involved and manages the transition? Or sometimes do they have more of a sudden exit?
It varies on an ad hoc basis.
So anything's possible?
Anything's possible. Does that make sense? Also, in that scenario, an owner might say, look, I want to go down to 2 days a week. I'm not done. Yeah. I actually don't want to start. I want to stop running this business, but I've still got a passion for sales or business development. So actually, I'd like to de-risk. So that's where they sell, I don't know, they would have to sell a majority stake in the business. And that's a definition that HMRC use. And you've got to, there's a bit of a fine line. You'd have to go for a tax clearance, but you could sell 60, 70, 80% of the business and retain a shareholding. So you're getting some value, you're de-risking, but you're empowering the younger generation of the management team, allowing them.
What happens if you don't sell 50%? What's the consequence?
The reality is, if you don't sell 50%, you won't qualify for what used to be called entrepreneurs relief.
Right,
so exactly, BADR. So
is that business asset disposal relief?
Absolutely, yeah, lovely name.
And that's already becoming less attractive, isn't it?
I mean, it's this current government isn't helping with that. Back, it used to be that it was 10%,
mm-hmm.
and then they capped it at 10 million.
Yeah.
They've then. The Conservative government limited that to £1 million at 10%, but now they've just increased it to 14%.
Yeah.
But it will be going up to 18%.
Next April.
Yeah. And that will, so 18% for the first million, and thereafter it'll be 24%. And I suppose it's making it less attractive to own a business, which
So that argument about selling at least 50% used to be a lot stronger of an argument than it's going to be after next April. Still again, 18% is lower than 24, of course, but only on the first million, so depending on the size of the business.
Yeah, but I suppose it also comes down to quality of life. Actually, you want to, your kids have flown the nest, and actually you want to spend more time with your wife traveling or husband, traveling the world. You ultimately need to de-risk, I think, an element to free up some cash, but also to allow the management team to come through to take responsibility.
Yeah,
so it's not just monetary driven.
But I was thinking there may be a pressure down to affordability, and we're going to talk about how that's funded in a moment. That's the point of today. But if it turns out that the way the sums work, the other managers or the business can't afford as much as 50, up until now that would have been a really serious disincentive because of the business asset disposal rates.
Yeah.
Now it's a bit of an inconvenience rather than a showstopper.
I do agree. I do agree.
So the other argument I've heard against MBOs, especially from those owners that are maybe not quite sure whether they do want to exit the business or not, is, well, surely I'm just paying for it myself. The business which I already own is going to help my managers to buy the business. So they're going to end up owning this without putting any of their own money in, and I've just given it away. So why would I sell it?
So I suppose, firstly, I would always, when we're doing a management buyout, look for the management team to put something on the line.
Right.
And everything's relative, isn't it?
Right. So it's not free then? They're not being given the business?
No, I think they need to have some skin in the game. I think that's important. So what you can often find is that they might have a element of value already because they own 10% maybe over time. Maybe they roll that. That's an element they've put in.
Yeah.
I suppose also it could be that actually that you want them to put in a set amount of money, and it's all relative to what they have as their personal wealth.
Yeah.
So we'll always try and have that conversation about what they're going to do, I suppose. But the important factor is, if you don't, you might find that your business is in a particular sector and it's just not as sellable. Does that make sense? And the trade conditions right now, it's not as sellable. So you saw a massive upsurge post-COVID, sort of June 2020, lots of restructures, lots of management buyouts. We were inundated. And the reality is they suddenly realised owners got a bit more, life's a bit more important.
Yeah.
And actually I want to make that next step. To make that next step, I need to get the management team in. But I think it's important about structuring it. So they put a bit of risk in, but the reality is you're not as involved in the business. So the business is running for you. And although I suppose I'd look at it slightly differently. If you did a trade sale, you'd get you're just going to get the same amount of money, and the business will generate the profits for them. So it's all relative, really.
That's an interesting point, because I'm still very much sat on the fence myself as to whether that argument holds water, because I can definitely see it from the owner's point of view to say, well, if I didn't sell it and I carried on operating, I still get that money anyway.
But there are different options. So the other way you could do it is you could do a management buyout, same as before, sell 60%, sell 70, sell 80 or 100, but actually raise some bank debt. So that's where you would go to possibly a high street bank, but there are also challenger banks available. And also there are, we're in the Midlands, great manufacturing country, part of the country. And the reality is asset-based lenders. So where you can borrow off your debtor book, you can also borrow off your assets, your fixed assets, being your plant machinery. You can also borrow off your stock if it's a certain level. So actually you get the management team to put some debt into the business. So that will allow you to
still the company taking on that debt?
Yes.
So are we talking about here who's offering personal guarantees?
So that when the banks get involved, there could be personal guarantees involved.
And that would then more likely be the managers that are part of the MBO and not the vendor.
Yeah, exactly. There would still be a risk element to the vendor. Does that make sense? Because the bank will always be above them in terms of the ranking. Sure. But what would happen in this scenario is the bank would look to put for them to put in personal guarantee potentially, or put some money in. It just just changes depending on what bank you're talking to. There'll be a preference. Or they feel that actually this person might own 20% of the business already, the management team, and actually they're putting quite a lot of risk by rolling that again into the business. So that's enough. It does vary.
So your comparison, which struck me there, is that if they were to sell it as a trade sale to a third party, they still get the same amount of money out, albeit different rates of deferred consideration, timing of payments, but they'd still be getting it out. And the business would still be carrying on earning money, which would pay the new owners back for having paid it.
It's a timing thing. So
really there's no difference. If you're hung up about the fact that the business is giving the company and I'm not gaining, just think about it that way. Compare it to then the alternative, selling to an external party. You still get the money out the same as you did before, and the business is going to still carry on earning money without you.
But ultimately, a business on a third-party trade sale, you will get a bigger amount of money, like you say, on day one.
Yeah.
But the thing, and this is a big important thing that a lot of business owners and don't always get talked through, is the reality is you're not going to get 100% on day one.
Yeah.
The reality is in this day and age, you are not going to get 100%.
It doesn't happen.
It doesn't happen. Are there deals I've done in the last few years?
Okay,
yes.
It can happen then,
Yeah, but that's when it's a strategic business. It's probably of a bigger size.
Right.
You're more likely to get more on day one the bigger you are, because actually you're such a strong, stable business.
Yeah.
There is a set level of value. But ultimately, you're not. So I would say it varies from, if you're right at the end of the smaller end of the spectrum, it could be as low as 33%, but that's rare. I would say the main spectrum is 50 to 70% on day one to be expected. And then there'd be a level of deferred consideration. So it's guaranteed, it's coming to you per the SPA for a legal document, but ultimately it will come to you over a set period of time that you've negotiated.
Agreement for those.
Yeah, sorry.
The abbreviations. And deferred consideration is different from earnout.
Yes, so deferred consideration is not set on the performance of the business. I mean, there are a lot of things to take into account on deferred consideration, because deferred consideration, who's guaranteeing it? So, for example, if we, think worst case scenario that you sell the business, you get your 50% on day one, the 25% to follow as deferred consideration, but in the first 18 months the business goes bankrupt.
Yeah.
Depending on how you structured that SPA, that share purchase agreement, it might determine if you're going to get that 25%, because the company that buying you might have only guaranteed it by the business you're buying, so wrapped it up in that. So it's coming from the profits of that business. So if that's not there, then you're not getting your 25%.
So as an advisor to the vendor, how would you suggest they structure that?
So then the way you would do it is the deferred consideration could be guaranteed by the buyer group. So the reality is, even if that entity dissolved for some reason, the buyer still exists, you'll still get paid ultimately.
Right. Okay.
I think that's a key metric. I mean, that's always harder to push, Dave. It's it's all a commercial negotiation, but it's one of the areas to consider.
So that's the deferred bit. The earnout then is different.
Yeah, the earnout's different. That is contingent on performance.
Right.
But maybe not just performance. There's other, I've had it before where it's wrapped up in, I don't know, a contract. You might have a customer concentration where you've got a specific contract that needs to renew. Right. And all you need is for it to renew in a certain period of time, and then you'll get it.
And when it does, you tick a box,
exactly,
and the condition has been met.
Exactly.
Okay.
But ultimately, what it is generally done is based on EBITDA. And it will say, let's just hypothetically say you've got a business, it's 500,000 EBITDA. It's going to say, look, if you don't hit 500,000, you won't get any money. Yeah. But actually, if you do, over the next 1, 2, 3 years, then we're going to pay you this much money. I think you see earnouts vary from 12 months to 5 years. And
that 5 years. Right.
I think 5 years, we can talk, that's a bit of an extreme. Yeah. So the most common, we 1 to 3 years of an earnout. I think as an advisor, the big thing we try to negotiate with an earnout is not to have a cliff edge. And by that, for every pound, if you're below 500, you don't miss out the whole contingent. There's a bit of a step change.
A bit of a sliding scale.
Exactly. Yeah. And actually, sorry.
No, I'm just trying to pick up questions as they occur to me as we go through, because you just mentioned EBITDA there, earnings before interest, tax, depreciation, and amortization, which I'm sure most listeners will know. But the question I had around that was, is it always EBITDA that's used as the basis for the multiplier, or are there some deals that are structured around EBIT or even profitable tax?
Yeah, it's fascinating. Mostly, the majority of sectors, it's EBITDA and what we call adjusted EBITDA, because we'll take a business and there'll be exceptional costs in that business. Whether you did a massive £100,000 expenditure on a new marketing strategy that was a one-off, we need to add that back. Also, we need to add back all of the director's costs and then put a replacement management charge in. So we call it adjusted EBITDA to create a consistent profit year after year so they can have a spectrum.
And that's often cropped up in discussions as well. So they take out, because of the structure, the business owners tend to pay themselves through dividends as much as they can, and that's the correction you're talking about.
Less attractive now, but yes.
It's definitely less attractive now, but anyway, it still happens because it's still, you get away with NI if nothing else. So that gets added back in, and then you have to replace it with, well, what would be the salary of somebody who, if they were an employee, were in that role? Yeah. How do you come up with that number? Easier said than done, right?
It's easier said than done.
Market rates and all that sort of thing.
You try to come up with a balanced amount. Where
this person you're trying to replace is a one-off by definition.
Yeah, no, absolutely. It's difficult, and you have to go, well, okay, if we were having to recruit a CEO for this business, actually, what would that cost be? You often find also that somebody might just be he's more manufacturing or sales, and actually you're not, and actually there's another person in the management team who's kind of the CEO who's pulling all the strings and pulling the business together, and actually it's just a certain function. So it's I think you have to come up with a reasonable thing. I think the important thing as a business is you've got to have a balance. Don't make it too high, because obviously you're reducing your profit, but at the same time, if you're trying to say a CEO of a business and you put in 50 grand, that's clearly not a relative, market salary. You need to be best estimate cost of the business, including employers NI, of what it will I business.
Okay, so we're having adjusted on EBITDA and not other measures of profit.
I suppose EBITDA, when you talked about EBIT, it's generally manufacturing businesses where the argument will be every year you have to spend a certain amount of capex just to stand still.
Yeah.
You can't have these ups and downs every year. You're year in, year out.
Repair and replacement level of investment.
Exactly. And what often can be the case is that argument will be, look, your depreciation is 500 and your capex every year averages 500. So actually we should measure it on adjusted EBIT.
Right.
If that makes sense.
That balances out.
Yeah. So,
and in terms of, and I know we're going down a rabbit hole of valuation here, but it popped up, so I thought.
Okay, no, that's fine. Don't worry.
We talked about EBITDA, let's say then, or other, and adjusting it. Now, time frame. Vendors will often try and sell you the dream of what this year's forecast is, or budget. And indeed, because of this new thing they've just done, a big new contract or investment, next year's going to be even bigger. And they'll try and sell the future. Or on the other side, they'll say, well, we had a bad year 3 years ago, or last year, or even the year we're in now, but previous years were okay. So how do you balance out all these different timeframes to average your number over?
It's a really key area, because I suppose it's when is the right time to go to market for your business, and that also leads into why you might be doing an MBO, and we can talk about that in a second.
Right, okay.
But ultimately you might have a business that, I don't know, let's say it traded at 750,000, it traded at $1 million, then it's just in this most recent year done 500,000.
Yeah.
And you'll say, but look, next year I'm going to do 1.2.
Yeah.
The reality is a business buyer is never going to believe that.
No.
You can't, unless there are some legitimate add backs, because actually there's £700,000 of extra costs and we can document it clearly and explain the story. The reality is it's 500,000.
If it hasn't happened, it doesn't count. Yeah.
So what I would say to an owner there is, look, if time's on your side, I would say let's go and deliver the 1.2, and then hopefully we've got a story of growth beyond that, and then let's sell off that.
Right.
And what we'll often do is we'll say, look, you've delivered your 1.2, but you're in your current year and you're going to do 1.4. And actually, look, let's say a sales process from meeting an advisor for a third party is going to take you 12 months to sale. So actually, if in your most recent year you've done 1.2, we'll try and sell it off your 1.4, because by the time you sell, you'll have delivered your 1.4 or ultimately delivered your 1.4.
As long as you've got the confidence you're going to.
Yeah, exactly. But what you can't do is point to, in 5 years' time, we're going to be 2.5, and I want you to base it off a multiple of that. No. That's just not realistic.
That's the gain for the purchaser,
That's the upside,
right?
Exactly. And they'll just say, look, I think we talked about it earlier, the reality is, why don't you go and do that then if it's that easy? Does that make sense? It's that whole concept. Exactly. But what it can do, if you've got a business that's showing a good growth trajectory, it's got a great pipeline, your sort of world with everything that you do, the reality is that will strengthen the multiple. So, and that's where that comes into
That's play. An argument we use a lot. It's not just about the EBITDA, but by systemizing the business and removing the owner's dependency on the owner and maybe some revenue concentration with customers, that increases the multiple at the same time as maybe increasing the EBITDA.
I mean, the reality is, I think management team and structure and automation, that's probably the single biggest thing in a business. That's the most important thing when you're thinking about any process.
Because surely any purchasers coming here thinking, well, what could I do for this business? How can I take it from where it is to something much bigger? Yeah. That's why I'm buying it.
Yeah. I mean, there's always the element you want a bit of, we should be doing that a bit more because that adds to the opportunity for the store, like for the owner. Sometimes you see these businesses that are just really efficient and that can scare buyers because they're just like, look, you might be delivering 25% EBITDA, we're never going to do that.
But is it not also true that a business may be on the doldrums on more of a long-term basis, and it's breaking even over a number of years, but it's still an attractive proposition for a buyer if it adds capacity or access to market, customer lists? So it's not just about multiples on EBITDA in that case, is it?
No. And I suppose that's a strategic business acquisition. Does that make sense? My argument would be it happens less than people think.
Right.
Ultimately, the main, everyone will go, okay, we're buying this because of the customer base, but it's generating me this much level of EBITDA.
Yeah.
They're always going to look at that at the end of the day. It might make them strengthen the multiple, but ultimately, I think it happens less. Now, look, in these tech businesses and different things like that, or you see it in tech platforms. You also see it even in industries when beer businesses were going through business. Heineken they bought a 50% stake in Beavertown, didn't they? And that was at a point when it was losing money. But they knew with their distribution network and the brand, they could make a massive return on their investment, and that's where they can look past what profit is. But they are fewer, and I think it's a bit more on scale.
Microsoft gave $10 billion for OpenAI, and it didn't even have a commercial model at the time. Did it?
Exactly. So that's I think it's when businesses have that level of scale of distribution to market. That's a different.
But it's less common than you think, and generally speaking, it's EBITDA. It's current performance, and maybe current year if you can pass that. But generally speaking, it's that.
I think in the SME world, I think it's less common.
I think you don't do the 3-2-1 weighting of previous years so often.
No, I don't think that's a thing. We see that a lot in some when accountants pull valuations together, but it's not really a thing. We will always try and sell off the most recent performance, because it's all about, and I think this is the new thing we established during the COVID, is it's about sustainable EBITDA. What is this business going to generate next year and the year after and year on a sustainable basis? So you might have done 1.5, but the reality is there was one-off order, and actually sustainably you're going to do $1 million.
And go on, the $1 million question, average multiples. No one answer for this, but if people are being told that 7 or 8 is normal, or 2 or 3 are normal, who's right?
Look, I think that the reality is 7 or 8, it depends on the sector. Do you know what I mean? So it really does vary on sector. So I think it's sector and size. So a business that's doing, I think there's some thresholds. So if you're doing 500,000 plus of EBITDA, you're going to get a certain level of multiple, and then if you're going to get above $1 million, you're going to get a certain level of multiple, and thereafter. I think it's amazing in the SME world, smaller businesses. It's amazing how many businesses will sell between 3 and 5 times. That is a common thing. But then you get to slightly more scale, it'd be 4 to 6, and then you hit a certain IT sector, and you're going to be in those 7s to 8s, and then depending on how much of a strategic, you can get into double digits as well.
And aren't there some sectors where it's more of a multiple on turnover? I'm thinking software in particular.
Yeah, so software will be linked to turnover. Other sectors that will be linked to turnover is accountancy practices, for example, where it's recurring revenue. Yeah. I also think IFA practices as well, which is a massive sector at the moment in terms of consolidation. That's also linked to turnover. But fundamentally, they might say, we're going to pay you this much money based on a multiple of your turnover. They'll always do a second calculation to work out what the EBITDA is, to just make sure sense check. Yeah, exactly. I think in the SME world, it's often done as a sense check as well, and EBITDA always has a factor to play. I would fundamentally say.
I know we're already almost running out of time, but I couldn't leave this without asking you a little bit about EOTs. What's an EOT, an employee ownership trust? What's one of them?
And I suppose actually that links into what you previously said, is it's not as attractive to do a management buyout now. So the reality is an EOT is very different. You sell the business to a trust, and the trust is the employees are part of the trust. And there'll be certain conditions that mean they sit in that trust, but basically it'll be employment. So whilst they're employed at that business, they'll be the owners of the business. Now the benefit, and it will get advertised, it's 0% tax to the vendor. That's not strictly true. So the reality is it is 0%. They will receive their money and they will not pay any tax on the money they receive. However, it's a rollover. So if in the future that the trust decides to sell the business, they will then have to pay the vendor's tax and then their own again.
Right, okay.
Now, the benefit there is obviously they've been given a business for free. It's the profits of the business, as you were saying earlier, that's paid for it. But ultimately, they are going to have to pay the tax at a future date. Now, it's a new thing that got brought in 2013, 2014. But it's gained momentum in recent years, partly through the tax advantages. And you hear bigger, Record Sounds, for example, was a massive one, I think, that hit the headlines. But it is becoming more common. They are increasing. I think they're very important to be managed properly. And by that, I mean, it's actually okay, Often they're not financed by banks because banks are warming up to the idea of getting comfortable. So it's often vendor financed, so they have to wait for their money. And so generally it takes on average about 5 to 9 years to pay out an EOT.
Wow,
it's quite a range. You're going to have to wait a while. But the benefit, again, like an MBO, you haven't got to go and market your business or work, you've just got to go for a process. And actually, you might have a fantastic culture in the business, and actually that means a lot to someone being part of the business. And what you can bring in from the word go, and I think this is a really important factor with an EOT, is bring in bonuses for them straight away so they can see a change. There's a tangible change, however small that bonus is. So even if it's the guy driving the diggers or whatever it might be, actually suddenly he feels really a part of it. And it can be performance linked, don't get me wrong, but there's an element that they can get every year up to about 3,600 tax free if they're part of the trust from a bonus perspective.
And everyone would be part of the trust. That's
but what I mean by not necessarily everyone is you can set rules in place when you set the trust up where you go, look, if you've been there 6 months, you're not part of the trust. You need to be there a set amount of time.
As long as it doesn't discriminate within those rules.
Yes, absolutely. It's only that sort of thing. Does that make sense? It's length of service. Now, it's going to be a really interesting, I think, next couple of years because we've had a massive flux of them. What's going to happen to these businesses? There is a trend that possibly they flatline, potentially. I think that's where they haven't been set up in the right way. They haven't incentivized the staff and they haven't got a management team properly set up in place. As you'll appreciate, and your job, you need a figurehead to lead that business. And I think that's an important factor. So it'll be very interesting as we see, and also interesting as we see some of them coming to market for sale, potentially, the successful ones. So
we haven't covered private equity either.
No,
there's almost another episode in all of this stuff.
Absolutely. I suppose we can touch on it quickly.
Quickly, what's that about?
I mean, that's ultimately where you've got a high growth business. You want it to be making 1.5 million, really. It could be less.
As a minimum.
Of EBITDA. And that's where you've got a high growth area. And either the management, you've got a great management team, or you want to just de-risk. You see the massive opportunity. There's loads more that can be done. And actually, you bring in private equity. They will have raised their funds for a combination of different ways, but generally they will have a fund of, let's say, 100 million. They need to invest in privately owned businesses, and they will have the professionals in place to help you grow those businesses. And they will generally hold them for a variation of 3 to 5 years on typical. And they are you need to have the right management team in place to sort of grow them. And it could be yourselves, because you could say, look, I need this much money, I need the funding, but I want to open up some certain markets. So to give you an example, successful ones, Chase Distillery. They sold, a percentage, 40% to BGF, and then sold out to Diageo. Now, part of their whole play there was it was linked to they needed to penetrate America more, and they needed that sort of expertise.
And Diageo was the platform to do that.
Well, sorry, no, that was with the BGF investment, and then obviously with them penetrating America, Diageo was suddenly a lot more interested. But it's that sort of element. So, I mean, that's a fascinating one on its own. I'd say PE are an interesting play at the moment because there are fewer deals available in the marketplace. So they're chasing after fewer deals. So when they are finding a particular business in a particular sector that's very interesting right now, they are particularly interested, I think. But I think, it's an interesting place.
All right. Well, there's definitely another episode in each of those things. I think
EOT
could be an episode, private equity could be, valuations could be. So it's been a great sort of oversight. Hopefully people haven't got too dizzy listening through to all of that whirlwind speed.
No apologies.
No, not at all. That's what we've got you in for. Brilliant. Thank you very much for coming in and sharing.
Thank you for having me. It's been an absolute pleasure.
I'm dizzy myself now. I'm going to go down and lie down in a dark room. Thank you. Thanks, Oliver.
Thanks, Dave.
And thank you for listening to another episode of the SME Growth Podcast from Wellmeadow. As we say every week, if you think that's been interesting or might be useful to someone you know, please forward a link, tell them about it in the pub or whatever. And in the meantime, good luck with your business.